If you own a home and you are over 65, there is a 3-step filing sequence sitting inside your county's own system that can legally stop a significant portion of your property tax bill, freeze what remains, so it can never rise again, regardless of what happens to home values in your neighborhood, and in certain states, defer what is left until the home is eventually sold. And the county assessor, whose office processes these forms, will never call you to explain that they exist. Not because they are hiding anything, because nobody in that system is paid to make sure you claim what you are owed. That job, by default, falls to you. And if you have not done it yet, you are almost certainly paying more than the law requires you to pay every single month right now. I want to say something clearly at the start of this video, because it is the most important thing I will tell you. And most people who need to hear it have already started talking themselves out of it. This does not only apply to lower income retirees. It does not only apply to people who are struggling financially. Some of the most valuable parts of what I am about to explain are worth the most to the homeowner sitting on a paid-off house that has climbed dramatically in value over the last several years, because that person is the one staring down the biggest potential tax increases and the one the freeze protects the most. But the basic exemption helps everyone. And the deferral program helps people across the full income range. So before you decide this is for someone else and not for you, stay with me, because I hear that from people all the time, and it is almost never true, and it always costs them. My name is Daniel. I am a licensed real estate attorney, and I have spent more than 16 years helping ordinary families navigate the gap between what they are legally entitled to and what they are actually receiving from county tax systems, state benefit programs, and local government agencies. And I will tell you the single most painful pattern I see in all that time. It is not fraud. It is not someone trying to game the system. It is the honest homeowner in their late 60s or 70s or 80s who has owned their home for decades, who has paid every bill on time, who has done absolutely everything right, and who is still paying the full unmodified property tax bill because nobody ever sat them down and said, there are 3 forms with your name on them, and filing them takes less than 1 afternoon, and they will save you real money for the rest of the time you own this home. That is the most expensive kind of mistake there is, because it is invisible. There is no late notice. There is no penalty for not claiming. There is no alarm going off. There is just money leaving your account every year, on time, on schedule, that never had to leave at all. So today I am going to walk you through those 3 steps, one at a time, in plain language, with the exact words you need to use when you call your county, the exact name of each form, and the exact sequence in which they stack on top of each other. Then at the end, I am going to give you several bonus moves that apply specifically to homeowners with real accumulated equity, because for the right person, those final pieces are worth more than everything else combined, and almost nobody talks about them. Stay with me to the end, because the 3rd step in the sequence is the one that freezes your bill permanently, and it is also the one that almost nobody files correctly or even knows exists. If you only do one thing after watching this video, it should be that one, but you need to understand the first 2 before the 3rd one makes complete sense. So let us go through them in order. Step 1, the homestead exemption. This is the foundation of the entire 3-step sequence. Everything else stacks on top of it. And despite the fact that it is the most basic property tax protection in the system, a significant number of homeowners who qualify for it have never filed for it. Not because they could not, because they assumed it was automatic. Here is the reality. In the vast majority of states, the homestead exemption is not automatic. It does not simply appear on your bill because you live in the home. You have to file a 1-page application with your county assessor's office, typically once, by a deadline that falls somewhere in the winter or early spring before the tax year in question. You file it once, and in most states, it remains in place for as long as you own and occupy the home as your primary residence. You do not refile every year. But if you have never filed it at all, you have been paying the full assessed value of your home every year with no reduction, and the county has no obligation to tell you. What does the homestead exemption actually do? It removes a fixed chunk of your home's assessed value from the calculation before the county ever generates your tax bill. Different states set the amount differently. In Florida, the basic homestead exemption removes $25,000 from the assessed value of your home outright. There is a second layer that removes an additional $25,000 from everything above the base, which together effectively removes $50,000 from what the county is allowed to tax you on. In Texas, the homestead exemption removes $100,000 from the school district portion of your tax bill, which is consistently the largest single component of a Texas property tax bill. In Georgia, the homestead exemption typically reduces the assessed value by $2,000 for state and school tax purposes. Every state does it differently, but in nearly every state, it is real money, and it is sitting there unclaimed for far too many people who qualify. Here is how to find out whether yours is on file. Call your county assessor's office or property appraiser's office, which is what some states call it, and say these exact words. I want to verify whether a homestead exemption is currently on file for my property. Give them your address. They will be able to tell you in under 2 minutes. If it is not on file, ask, what is the form called, where do I get it, and what is the filing deadline? In most cases, you can download the form from the county website, fill it out at home, and either mail it in or drop it off. Bring a copy of your government-issued ID and proof that the home is your primary residence, which is usually a utility bill or a voter registration card showing the address. That is the entire process. One afternoon, filed once, applied for the rest of the time you own the home. Now, here is something important for renters watching this. I know some of you are thinking this one does not apply to you, and in the direct sense, it does not, because you do not own the property. But I want you to understand the indirect connection. Your landlord pays that property tax bill. Every dollar of it is factored into what they charge you in rent. When homestead exemptions reduce property tax bills across a community, that reduction puts pressure on the cost side of what landlords pay to own the property. It does not guarantee your rent will fall, but it puts a meaningful brake on how fast it can rise. So even for renters, what happens with property tax exemptions in your community directly affects the trajectory of your housing costs over time. Step 2, the senior exemption, also called the over 65 exemption. This is the one the county will almost never tell you about on its own, and it is the step that most homeowners who have filed the homestead exemption still have not taken, because they assume that the homestead exemption is the only thing there is. It is not. Most states that offer a homestead exemption also offer a completely separate, entirely additional exemption that kicks in specifically when you turn 65. It is not an upgrade to the homestead exemption. It is a second form stacked on top of the first. It requires its own application. It has its own deadline. And you have to request it by name, because the county assessor's office is not required to reach out and inform you that you have become eligible for it. What does the senior exemption add on top of the homestead exemption? The specifics vary by state, but the numbers are real. In Texas, once you turn 65, you are entitled to an additional $10,000 homestead exemption on the school district portion of your bill, stacked directly on top of the base $100,000 homestead exemption. That means the school district is calculating your bill on $110,000 less of assessed value than they would be without either exemption. In Florida, depending on the county and the income qualification, the senior exemption can add another $25,000 or even $50,000 in assessed value reduction on top of the base homestead exemption, effectively doubling the total write-off for qualifying seniors. In Georgia, there are additional senior exemptions at both the state and county level, some of which eliminate school tax entirely for homeowners over 62 or 65, depending on the program. Now, here is the specific misunderstanding that causes comfortable retirees to skip this step. They hear the word senior exemption, and they assume there must be an income test that will disqualify them. In some states, there is an income limit, but in more than half the states that offer a senior exemption, there is no income test at all. In Texas, Florida, Georgia, Tennessee, Alabama, and several others, age is the only qualification. You turn 65, you file the application, you receive the exemption. Your income, your savings, your paid-off home, none of it disqualifies you. If you are 65 and you own the home you live in, you qualify. Full stop. Even in states that do have an income limit, those limits are often far higher than people assume. A lot of seniors glance at the word limit, assume they must exceed it, and never check. That assumption is costing them money. The right move is to check. Call the county, ask what the senior exemption income limit is in your state. Compare it to your actual income and confirm whether you qualify. The call takes 5 minutes. The savings can be hundreds of dollars per year for the rest of the time you own the home. Here is how to file. Contact your county assessor's office again, the same office you called for the homestead exemption, and say, I recently turned 65 and I want to apply for the over 65 senior homestead exemption. Ask for the form by that exact name. Ask what documentation they need, which is typically a government-issued ID showing your date of birth and proof that the home is your primary residence. File the form before the annual deadline, which is usually the same deadline window as the homestead exemption, in the winter or early spring. One important timing note. In most states, the senior exemption applies beginning in the tax year in which you turn 65. That means if you turned 65 this year and have not yet filed, you may still be within the deadline window to have the exemption applied to this year's bill. Call and ask. If you missed this year's deadline, file immediately so it is in place for next year. Step 3. The senior assessment freeze, also called the senior tax ceiling or the over 65 tax freeze depending on your state. This is the third step in the sequence, and it is the most valuable one by a significant margin. It is also the most underused. Of the 3 forms in this sequence, this is the one I encounter most often going unfiled, even in cases where the homeowner has correctly filed both the homestead exemption and the senior exemption, and the gap it creates grows larger every single year that it goes unfiled. Here is what the senior assessment freeze does. When you file this application and it is approved, the county takes your home's assessed taxable value at the time of approval and locks it in place at that number permanently. For as long as you own the home and the exemption remains in place, your property tax bill is calculated on that frozen assessed value, regardless of what happens to your home's actual market value. Think about what that means in practical terms. If you live in a neighborhood where home values have been climbing, your market value might increase by 5 or 10 or 15% in a single year. Normally, your assessed value and therefore your tax bill would rise with it. With the freeze in place, none of that market appreciation can touch your tax bill. Your bill is calculated on the value that was frozen at the time you applied. Your neighbor without the freeze watches their bill climb year after year. Your bill stays flat. In Texas, the senior assessment freeze is called the over 65 tax ceiling. Once it is in place, your school district taxes are frozen at the actual dollar amount you paid in the year you filed. Your home's value can double. The bill cannot rise. It is locked in. If the school district cuts its tax rate, your bill can actually decrease, but it cannot increase. The ceiling only works in one direction. In California, a program called Proposition 60 and its successor programs allows qualifying seniors to transfer the low assessed base value from a home they are selling to a replacement home they are buying, which achieves a similar effect. In Illinois, the senior assessment freeze locks in your equalized assessed value for qualifying seniors with income under the state threshold. Each state implements the freeze concept differently, but the core protection is the same. Once it is in place, appreciation cannot increase your bill. Who does the freeze help the most? The homeowner sitting on a paid-off property in a neighborhood where values have been rising. That person is the one looking at the most potential future tax increases. That person is the one who benefits most from locking in today's assessed value before it climbs further. If you are in that position and you have not filed the freeze application, every year you wait is a year you are paying taxes on an assessed value higher than the one you could have frozen. But I also want to be direct about something. The freeze helps everyone who files it, not just people in rapidly appreciating areas. Even in a stable market, locking in your assessed value protects you from reassessments, from mill rate increases, from any upward pressure on the tax bill. Once it is frozen, the only way your bill goes up is if a non-school district local tax rate rises, and in many states, even those are limited once the freeze is in place. Here is how to file. Contact your county assessor's office again and say, I am 65 or older and I want to apply for the senior assessment freeze. Or in Texas, say, I want to apply for the over 65 tax ceiling. Ask specifically what that form is called in your county, because states and even individual counties sometimes use different names for the same program. Ask for the form, ask what documentation is required, which is typically your ID, proof of age, proof of residence, and in states with income limits, a copy of your most recent tax return or Social Security income documentation. File before the annual deadline. One critical note on timing. In many states, the freeze is applied beginning in the tax year in which you file. It does not apply retroactively to prior years. Every year you delay filing is a year of potential assessed value increases that are are not being frozen. The sooner you file, the lower the assessed value you are locking in. This is not a situation where waiting makes sense. If you are 65 or older and own your home, call the county assessor's office today and ask whether the senior assessment freeze is available in your state and how to apply. Now let me walk through several things that do not fit neatly into the three main steps, but that are worth real money to the right homeowner. The first is the property tax deferral program. This is separate from and in addition to everything we have discussed so far. In a number of states, once you reach a qualifying age, typically 65 or older, but sometimes lower, you can choose to stop paying your property tax bill entirely on a year-by-year basis. The unpaid taxes accumulate as a lien against the property, earning a low interest rate set by the state. When the home is eventually sold, whether by you or by your estate, the accumulated deferred taxes and the modest interest are paid out of the sale proceeds. Until that point, you owe nothing and make no payments. Who is this for? It is for the homeowner who is asset rich but cash flow constrained. The homeowner who has a significant amount of equity in a paid off home but is living on a social security check and a small pension and finding that the property tax bill is a genuine monthly strain. The deferral program does not eliminate the tax. It moves it. It preserves your cash flow while you are living in the home and settles the account when the home changes hands. For the right person, this can free up hundreds of dollars a month while allowing them to stay in their home without financial stress. Deferral programs are available in varying forms in Texas, California, Oregon, Washington, Colorado, and several other states. The specific income limits, age requirements, equity requirements, and interest rates vary. Ask your county assessor whether a deferral program exists in your state and what the requirements are. The second bonus item is the surviving spouse carryover. This is one that families lose by accident at the worst possible moment, and it is entirely preventable with a single phone call. When a senior homeowner passes away and the home transfers to the surviving spouse, the senior exemptions and the assessment freeze do not automatically transfer with the property in most states. The surviving spouse has to refile. If they do not refile, the tax bill can jump significantly in the very year the surviving spouse is dealing with grief, with estate administration, with all the practical demands of losing a partner. And because nobody mails them a notice explaining that the exemptions have lapsed, many surviving spouses do not discover the problem until they receive a significantly higher tax bill months later and cannot understand why. Here is what you do. If you are in a couple and one of you passes away, the surviving spouse should contact the county assessor's office within 30 to 60 days and ask, what forms do I need to file to maintain or transfer the homestead exemption, the senior exemption, and the assessment freeze in my name? In most states, the surviving spouse who is also over 65 and who continues to live in the home can refile for all three and have the same protections restored. The key is filing the paperwork before the deadline, not waiting to receive a bill and then trying to correct it after the fact. If you are reading this while both spouses are still living, the action item is simple. Make a note that if you outlive your spouse, contacting the county assessor about exemption transfers is one of the first administrative tasks to handle. Put it on a list. Keep that list somewhere you can find it. The third bonus item involves something that surprises people until they calculate the number themselves. In a number of states, once you reach a certain age, your vehicle registration fee, your annual excise tax, or both are reduced or waived entirely. The specific age threshold varies. The amount varies. In some states, it is a modest reduction. In others, it is a complete waiver. It is not the largest item on this list by any measure, but it is money you are legally entitled to stop paying, and the only reason most people keep paying it is that the state does not send a notice explaining that it has changed. You have to ask. Contact your state's Department of Motor Vehicles or Department of Revenue and ask whether there is a senior discount or exemption on annual vehicle registration fees. If there is, ask what the age threshold is, whether there is an income limit, and how to apply. Now I want to bring all of this back to a real person because I think the numbers become clearer when you can see them in the context of one actual household. I worked with a man I will call Robert. He was 74 years old, living in a suburb outside of Dallas, Texas. He owned his home outright. He had bought it in the early 1990s for $138,000, and it was now assessed at just over $410,000. He was living primarily on Social Security and a small pension from 22 years at a manufacturing company. His combined monthly income was about $2,400. When we sat down and looked at his situation, here is what we found. He had the basic homestead exemption on file. He had filed it when he bought the house, but he had never filed the over 65 senior exemption that became available to him when he turned 65. And he had never heard of the over 65 tax ceiling, the freeze. So his tax bill was being calculated on the full appreciated assessed value of his home, climbing every year as the neighborhood appreciated, with only the base homestead exemption reducing it. Here is what the three-step sequence looked like for Robert specifically. Over a 10-year projection based on the appreciation rate his neighborhood had been experiencing, the difference between having the freeze and not having it was estimated at more than $4,200 in total school district taxes alone. That number grows every year the freeze is in place and would have been substantially larger if he had filed at 65 instead of 74. And here's the thing I want you to sit with for a moment. Nothing about Robert's life changed as a result of filing those two forms. He did not move. He did not refinance. He did not sell anything. He did not have to qualify for a program with a complex application or navigate a government bureaucracy. He made 2 phone calls, picked up 2 forms, filled them out at his kitchen table, and dropped them off at the county assessor's office on a Tuesday afternoon. The forms did not cost anything. The process did not require a lawyer. And the result was a frozen school district tax bill and over $100 per year in direct savings from the senior exemption, both applied automatically going forward. He told me afterward that his main emotion was frustration, not at the county, not at anyone in particular, just at the fact that he had been eligible for those forms for 9 years and nobody had ever mentioned them. 9 years. His property had appreciated significantly during that window. The assessed value the freeze locked in was 9 years higher than it would have been if he had filed at 65 the way he was entitled to. That is the painful truth about these forms. The law is on your side. The exemptions are real, but the system is not designed to make sure you claim them. You have to claim them yourself. And every year you wait is a year you will not get back. So here is exactly what I want you to do this week. And I mean this week, not at some general future point. This week, call your county assessor's office. If you do not know the number, search your county name plus assessor or property appraiser and the phone number will come up in the first result. When they answer, say, I want to verify whether the homestead exemption, the senior over 65 exemption, and the senior assessment freeze or tax ceiling are currently on file for my property. Give them your address. They will be able to tell you in a few minutes which of the 3 are on file and which are not, but you can build it yourself in one afternoon with a phone call and a One last thing, and it matters. What I have walked through today is general education, not personal legal or tax advice. The specific rules, amounts, income limits, age thresholds, and deadlines vary by state, by county, and sometimes by individual circumstances. Always confirm your own situation with your county assessor's office or a qualified professional before you act. These programs are real and widely available, but the details depend entirely on where you live. If this video helped you, send it to one person you know who is over 65 and owns their home. It costs you nothing, and it might put hundreds of dollars a year back into the pocket of someone who earned it over a lifetime of doing everything right.